Greetings, greetings to all of you, and welcome to our discussion of financial accounting. In this session, we're going to be focusing on IAS12. IAS12, which is concerned with income taxes, right? And we're going to look at this from the perspective of these two modules. This is a semester module, FAC3701. And FAC3764, which is a year module. Right. So these are the two modules which cover IAS12 income taxes. Now, when you were talking about financial accounting at third level, somebody told you about a topic of income taxes. And they probably spoke about deferred tax, right? Because a lot of conversation takes place in the lower levels about deferred tax, but you guys are going to see deferred tax when you come to third level. And so welcome to third level. And we're going to introduce you with income taxes. And income taxes is the standard that also includes deferred taxes. So perhaps somebody told you that that is a very difficult concept, but I want to tell you that I have so much experience first as a student and then now as a tutor that the topic has an appearance of being difficult, but the way we teach you from experience over time should make it very simple for you. So we hope that this is going to help you understand the concepts and be prepared for your assessments. Now, one thing that you need to keep in mind about income taxes is that in every assessment that you're going to get, there will be a question on income taxes. It's just not possible that there won't be income taxes question, and more particularly deferred tax. It's not possible. There is no assessment without deferred tax. So it's something that you have to be very aware of, and it's not going to be difficult, right? It's not difficult at all, but there are just certain rules which we will be very happy to take you through. Right, from Resource Hub and our partners, we're happy to start introducing you to the introduction for income taxes and exempt differences. This is very beautiful. I love this topic because it's very soft, but at the same time, then students struggle with the very basic stuff. Well, yes, because this is more of an abstraction from our normal standard accounting standards. It's more of an abstraction in many ways. But we're going to explain to you how this is going to work. Now, I want you to listen very carefully. I want you to follow. All right. And you can ask questions if you don't understand. So this is our email for Resource Hub. If you have any questions that you would like to ask, Resource Hub online at Gmail. Right. And if you would like to join classes, this is the, I hope I write it correctly. This is what is this? The cell phone number, the WhatsApp number rather, which you must engage. Right. For those who are already in our classes, there's no need for you to follow this because this is generally prepared for those outside. We have similar resources for you. So there's no need for us to be addressing you here. In particular, regard to this uh, income taxes. Right, and we're going to get started. So let's talk about the taxes that we find in the world of business. So we have income tax, right? So income tax is a tax that you pay. So let's say we have income tax here, and income tax is the tax that you pay, or rather, which a business pays. Income tax is paid by a business on their profits. Or let's expand and more correctly, close to more correctly say income. Then we also have what is referred to as sales tax, which is also referred to as a transaction tax. In South Africa, we refer to that, we have value-added tax, right? This is the tax that is levied on sales transactions, right? Um, so it is levied on sales transactions, the VAT. That's a sales tax. Then we have, right, when we come to income taxes, right, income could be profits. It could also be a gain. So we could also have capital gains when you dispose, like you sell an office building and then you have capital gains. And I also think we have employees tax, or which is referred to as pay as you earn. So um, this is what you have for employees, which is withheld by the employer. Then you also have dividends tax, um, which is taxes withheld by the company which is paying dividends to the shareholders. So the company which is paying dividends to the shareholders has the responsibility to withhold the tax and pay it over to SARS. And then we have various other taxes, we can just call them withholding taxes, and many, many, many um, other taxes. So one of the things that you need to know, it's important for general understanding. It's also important now that you guys have the year students also have quizzes. Sometimes they give you quiz, and you should also uh, know. So you should know that when we say profit before tax, right, we have a figure there, and then we have say income tax expense, then we have another amount there, right? So previously in the lower levels, first year and our second year studies, the income tax expense was always provided, right? But at third level, you need to calculate that, right? So we're going to teach you how to do the calculation. But one of the things that you need to know in advance is that you have your sales tax, your pay as you earn, your employees tax, your dividends tax, and any other taxes. These are not part of the income tax expense. So your income tax expense for the purposes of FAC uh, is going to be based on profits, right? Now this is for the purpose of FAC. For the purpose of taxation, it's going to be wider. It's going to be wider than just for FAC. Brilliant. So now let us begin from where it starts. Let's go back to the source of all this. So we said the income tax expense, which you see in the income statement or the statement of profit or loss and other comprehensive income. You have the income tax expense. Now that income tax expense is based on uh, accounting profit. So accounting profit is also referred to as profit before tax. Now, I want to repeat that so that you understand. We have an income statement that says sales. We subtract cost of sales. All right. Then we get gross profit. We add other income. We subtract other expenses. We subtract finance costs. Then we have profit before tax. This profit before tax is what we refer to as accounting profit. We reach this profit before tax by following accounting standards. So as a result, it's referred to as accounting profit because we reach that amount or that figure from applying or through applying accounting standards. That's why it's called accounting profit, right? It's also referred to as profit before tax because that is where that is the last line item we enter, right? And then after this profit before tax, we have the income tax expense. So the income tax expense is going to be based. So the basis, right, the starting point, remember, the starting point for calculating income tax is profit before tax. Now, we're not going to calculate tax directly from the profit before tax. There's going to be some adjustments, all right? But the starting point of the adjustments, the first thing we write before every adjustment, we start by stating the accounting profit. We start by the profit before tax. Then from there, we proceed using the format that we're going to teach you. Right, so we have accounting profit. Right, that is what we call accounting profit. It is determined according to accounting rules or accounting standards. Right. And normally, this accounting profit, now this is from an examination perspective, right? From an examination perspective, your profit before tax will require adjustments normally so that you can get the corrected profit before tax. Now, I want you to follow this very carefully. I want you to do that because a lot of students lose marks. There is a demon that causes confusion in the minds of students, right? So I'm trying to exorcise that demon on your behalf. There is a demon that confuses students, and I'll tell you how that demon operates. Now, accounting profit is determined using accounting standards. Remember, I demonstrated how we get to sales, cost of sales, other income, until we get to profit before tax. But sometimes, so if we say sales minus cost of sales, all right, plus other income, so this will be gross profit plus other income, minus other expenses, minus finance costs, gives us profit before tax. Now, this is the final amount. But if you notice, it's made up of a lot of things that you included here. So when we make an adjustment, I shouldn't say adjustment, it should be corrections. And the corrections, not adjustments, corrections. So sometimes what they do, now I'm speaking about this from an examination perspective. The examiners, this is what they do. They give you an accounting profit, a provisional profit before tax, and then they say, right, calculate the correct profit before tax. Calculate the correct accounting profit. Right? Determine the adjusted accounting profit. So they do that because there will be errors that could either affect sales, errors that could affect cost of sales, errors that could affect other income, errors that could affect other expenses, errors that could affect finance costs. So what they mean, what the examiners mean is this profit before tax is not correct, right? From your normal accounting, something is not right. So you need to adjust here. So the adjustments may take the form of omitted transactions. So you might be given a case where they say the junior accountant forgot to record this. So there's a transaction that was supposed to be recorded and someone did it. And now you have to go and say, let me correct. If it was a sales transaction, then you need to record the sales and the cost of sales, right? Then you adjust that, the profit before tax. It could be errors, right? An error where someone posts, for example, they make an error and they post here. I could think of an error like you have depreciation, right? You have an asset. Let's say equipment, you buy equipment. And that equipment, you buy it for 100,000 rand. And then our junior accountant includes the whole 100,000 rand as an expense. So they're going to subtract that. And then the examiners are going to tell you that the junior accountant, they bought equipment and it was subtracted as an expense. And you know that that is an asset. So you must reverse that. So that's the adjustment you might have to do to your profit before tax. You have to reverse that and do proper calculation of depreciation. You know, this is not an expense. This is an asset, right? So you need to know accounting standards. So as we advance later on, you might see that there's going to be some changes in the amounts that must be included. So the directors could change something. After you've prepared your financial statements, you give them to the directors. The directors can change the estimates, can change accounting policies. And then you have to go back and adjust the financial statements. Or it could be adjusting events after the reporting period. Like, let's say that there is a debtor who was struggling and that we know that the debtor won't be able to pay. We have to write off. So I want you to understand this because these are mistakes. Great. So let me say that this is a mistake. In other words, this figure here, this accounting profit, this profit before tax will not be correct. So before you start calculating income tax, you need to use the correct amount. So they could give you an amount and say, the entity made so much profit before tax. And then as you read, you will realize that there are mistakes. Then the first question will say, calculate the correct. The correct profit is calculated using accounting standards. You look for what's wrong in these amounts. I want to repeat that. Error is what you look for. Right. Another name for error is a mistake. That's you're looking for. And another word for error is wrong. Right. So you're looking for what's wrong here in this amount. Okay. And then you need to correct that. You know why I'm repeating that? Because students get confused. I'll show you where they get confused. Right. So I say here, the corrected profit before tax will be based on accounting standards, not tax rules. So when they say correct, prepare the correct, you have to follow, you have to fix the errors, fix the mistakes, fix all the wrongs. Then the corrected profit before tax, which you corrected, is the starting point in the determination of income tax. Right now you have the correct profit before tax, which has been corrected of errors, of mistakes, of anything wrong. Now, I want you to make sure you understand that portion because it's going to be there in your examination, in your assessment. The examiners are going to say, first of all, correct your profit, right? And there is an exercise that I prepared, which is also accessible to you. So you can enjoy that exercise. And it's exercise 1. You can also get it after this. Right, so I'll come back to you later on to say why was I saying, why was I emphasizing on corrected profit before tax? I'll emphasize that for you. Right, so we are still discussing terms. Then we have what we refer to as taxable income. This is the profit or loss for a period upon which income tax is payable to SARS. This figure is calculated by adjusting the accounting profit, this profit before tax, according to the rules established by the tax authorities. Now, what I'm saying there is, first of all, you now have your corrected profit before tax, according to accounting. Now, with your corrected profit before tax, you need to know how much income tax expense are you going to pay. And remember, this income tax expense is always going to be an estimate. Okay, it's always going to be an estimate because you estimate that SARS is the one that gives you the final, and it could be like 6 months later, but you need an estimate for your financial statements now, right? So you're going to estimate using the rules. Now, what happens is now you have your profit before tax, and you take it to SARS. You stand in a queue, and then you go to the next till, or you go to the teller in a SARS office with your profit before tax. You have printed it, and then you sit down with the SARS official. Then you want to determine how much tax you are going to pay. Then in your profit before tax, you would have items that make the sales, cost of sales, plus other income minus other expenses minus finance costs. Now, this is your profit before tax. So you have prepared this up to profit before tax, and you now at SARS. Then with SARS officials, you're going to look at the sales and everything that makes up the sales, all the transactions, and SARS will tell you that they don't like something there. You must remove it. So SARS will tell you to remove something here, and will tell you to add something here in your sales, which you left out. But now SARS is a tax authority. Remember I said they have their own rules. I said according to the rules established by tax authorities, that's us. They have their own rules. So that is why when you as an accountant, you have prepared your profit before tax using accounting rules. These accounting rules. Now you go to SARS, and SARS looks at your rules and they tell you, in your cost of sales, I don't like this, take it out. In your cost of sales, you left this, add it in. In your other income, I don't like this, remove it. In your other income, you forgot to include this, I want it included. Now, these are rules. This is no longer accounting. These are rules from SARS. In your other expenses, I want you to remove this item. I don't like it. In your other expenses, why? I want you to include this item. In your finance costs, this is not acceptable. I want you to remove this element of your finance costs, and I want you to add this element of your finance cost. So you go to SARS. You go through your financial statements, and they say remove this, add that, according to the rules of SARS. Then what you have at the end is not the same amount. Remember, it's no longer profit before tax, because SARS has applied their own rules, right? For each and every element you put in, SARS has applied their own rules. So it's no longer your profit before tax. It's now called taxable income. or taxable profit. Now, on that taxable profit, then SARS will gonna say our tax rate is 27%. So SARS will say, now we can apply this tax rate on the taxable income. Okay. So we remember we what we did is that we took a taxi, we drove to the SARS office with our profit before tax, and our profit before tax was prepared according to accounting standards. This is the correct according to accounting standards. But this is now the rules of SARS. When we are sitting with SARS at the office, SARS will tell us we don't want to remove this figure, remove this figure, add this figure, add this figure. The reason why SARS does that is that they want to determine their own profit before tax, their own, and that is amount is called taxable income. So on that taxable income, you apply the tax rate of 27%. So what happens is your profit before tax is going to be different from your taxable income. Not because this profit before tax was wrong, but because the rules applied by SARS specifically to determine how much tax you are going to pay. Not because something was wrong. There was nothing wrong here. In terms of accounting standards, there's nothing wrong. There's no error. There's no mistake. We have fixed those mistakes already. But so what is being fixed now is not a mistake, but it's just applying the rules of SARS to say we are here, how much can I pay you? And SARS looks and say, okay, tell me how is your sales composed, and then you show them. To my sales, there's sales from Namibia, there's this from this is a what, this is a what, and they say remove this, add this. Let's go to cost of sales. You explain, say take this out, include this. You forgot this, you did this. And then eventually, as you sit there with SARS, they determine the taxable income. Now, I have emphasized to you earlier to say corrected profit before tax, and I said there is a demon. That demon, which causes confusion in the minds of the students, is when students think, when they are told to calculate the correct profit before tax. Now, I want you to listen here, what students do. The instruction says calculate the correct profit before tax. And then the demon enters into a student. And then the student starts removing and adding according to SARS. But that's not a correction. Right? Here, when we talk of a correction, we're talking of mistakes, accounting mistakes. Calculate the correct profit before tax. You use accounting standards, which we spoke about here. Like there could be omitted transactions, there could be an error, there could be changes. Remember, we're talking of mistakes, errors, wrongs. Something that is wrong. You need to correct according to accounting standards. Now, that demon that I told you about, when the lecturer says calculate correct profit before tax, students come and apply the SARS adjustment, and then they submit that. And the lecturers are shocked, like, but you don't understand these things? Oh. And then I'm saying this now. So maybe as a student, you go through this and say, but this is easy. Who would we get confused here? Well, I'll read the report again from the lecturers. They'll tell you the exact same thing. Students are told, calculate correct profit before tax. Then they start applying the rules of SARS. And they remove that, they do this, and then they lose marks, and everything becomes mixed up. Right, so we were talking about taxable income. Taxable income is the profit or loss for a period upon which income tax payable to the upon which income tax is payable to the South Africa Revenue Service. So you will say tax rate, right, multiplied by taxable income. That is what gives us the income tax expense. And remember that this taxable income is not your accounting profit before tax, because we take our profit before tax, our accounting profit, we take it to SARS, and then SARS is gonna ask us according to the rules, their rules, right? They're gonna change the amounts and change the amounts until the profit left is called taxable income or taxable profit. Then current tax is the amount that we're going to pay currently in the current year, right? So this is the tax calculated according to the rules and regulations of SARS, right? So I want you to know that current tax is what you pay to SARS and is based on taxable income. So roughly, this is how we do current tax. Roughly, remember, we cannot be quite exact. I say this because some students might be advanced and they might see a 99% accuracy in what I say. Right. So, right. So current tax is what SARS wants us to pay during the current year. So we must pay in using our bank, must go into our bank account and click on pay to SARS, and the money disappears from our account. So if we had 100,000 and we pay a tax of 60,000, we actually pay the 60,000 and then we are left with 40. So current tax, I want you to understand that, is what affects our bank account. Is we actually pay that to SARS. It's called current tax. And it's based on taxable income, right? Not accounting profit, right? So the current tax is not 27% of profit before tax. It's not. It's 27% of taxable income. And remembering that taxable income comes from profit before tax, but we have to make adjustments according to the rules of SARS until we are here. Right. So I want you to make sure you understand that. Then there is current tax, right? Then there's what is called an income tax expense. This is the expense, right? Under profit before tax, right? So I want you to appreciate this. So income tax is more than just current tax, because income tax consists of current taxes. Now I want you to remember that current tax is what you actually pay to SARS. SARS gives you the rules that you must follow. And then when you follow those rules, they say that amount is current taxes you must pay. But there could be other taxes which were not paid to SARS, but they were paid to foreign countries. Those are also part of current taxes. No. Of the income tax expense, my apologies. Right. Plus accounting adjustments to the taxes paid. Now I have to explain this to you and explain why should we have accounting adjustments to the taxes paid. So the next topic is why adjust taxes paid. So I want you to follow clearly, because it helps if you have a clear understanding, a framework of understanding that will help guide you. If you are confused, then it's very difficult to make sense of something. So I want to start by saying that expense, which you say profit before tax and then income tax expense, that income tax expense is made up of the current taxes, which is what you actually paid to SARS, plus foreign taxes, which you paid in other countries. But these have to be adjusted, these two, both current tax and foreign tax are cash payments. But at our level, we say they are cash payments. And then we have to make adjustments to those payments. And then your question is, but why are we making adjustments? So I'm going to take you to the concept of tax laws differing from accounting standards. So I'm going to give you a very good example, right? So I want you to follow that example clearly to understand why, after paying tax to local authorities, which is SARS, and after paying tax to foreign authorities, why don't we just include that and say this is the income tax expense? Why do we have to make accounting adjustments? Why adjust those amounts when they have been paid? Right. So I want to give you a very good example. This is a company with a December year end. Right. The year end is December. So it runs from 1 January to 31 December. So what happens is this company pays rent 10,000 every month, right? This company pays rent 10,000 every month. Okay. Now what happens is that they have a contract with the owner of the property, right? They are renting from. So this is the landlord. That they will pay from January to October, right? So this is the contract that they agreed, that they're going to pay from January to October. Then for the month of November and December, they shouldn't pay. They can pay for the month of November and December. They can pay in January, right? Do you understand this? This is a contract. This is an agreement with the landlord. This is an agreement with the owner of the property they're renting from, that you pay 10,000 from January to October, right? This is the contract. This is the agreement. But then November and December, you will pay in January, right? So the actual amount paid during the year ending 31 December is for 10 months, January to October, because of the rules that they agreed. So according to the rules, they paid 10,000 times 10, right? Which is 100,000. This 100,000 was actually paid. Do you understand that? But it was paid according to the rules or contract. And then the months of November and December were not paid for. So how do you account for this in the financial statements? What is the rental expense? Not the rental paid, the rental expense. It can't be 100,000, right? As you know the rules. It's 100,000, which was actually paid. But there needs to be an adjustment for those 2 months which were not paid. But those 2 months were not paid as a result of the agreement or contract. So it's not a violation. It's an agreement. So, but that agreement has to be taken into account. We need to look at the agreement and say, okay, this is your agreement. You actually paid 100,000. But for accounting purposes, your agreement wants you to pay in January, but it is an expense for November and December. Although you didn't pay because the agreement says don't pay, we want it included as an expense. So eventually the expense is 120,000 for all the months. But the contract says pay for 10 months to October. That is what you agreed. So there has to be, so an expense is not the actual amount you paid. Right, remember that. An expense is the amount you paid adjusted for overpayment or underpayment. So there's going to be an adjustment. Right. So if you pay rent 100,000, that's not going to be the expense. Sometimes you can have a prepayment there. Sometimes you can have an accrued expense. Now, the same principle applies to taxation. You have a contract with SARS. You have a contract with government. It's not a contract, but I'm trying to link that with the rental contract. It's a law. So you're going to pay a certain amount according to the law, right? You pay 100,000, right? Because SARS was telling you to remove this, add this, remove this, add this. So according to those rules, you paid 100,000. But the income tax expense is not made up of what you actually paid. That's not an expense. An expense is what you accrued, whether you paid or not. So the current tax is what you actually paid, but there has to be an adjustment for overpayment or underpayment. Either way, there is a prepaid tax asset, right? Remember those prepaid expenses, or an accrued tax asset. So we're not just going to take the amount actually paid, but we have to make adjustments. Like I showed you there, we pay a certain amount according to the contract, according to the rules, and it's fine. But according to accounting, we have to look at the rules and say, wait a minute, there is some tax that was incurred, right? Did I say accrued? Incurred. Maybe I might have said accrued at some point, but basically I want incurred. There's some expense that is incurred, but according to the rules of SARS, SARS says you are not going to pay it, but it is an expense. You could pay it later or whatever the adjustment is, but it is an expense. So this is why we have to adjust the taxes paid. So you need to remember that in accounting, income is not the amount that you received, but it's the amount you are entitled to for the period, whether you received that or not. An expense is not the amount you paid, but it's the total amount you incurred during the year, whether you paid it or not. That is why when we pay SARS, we have to do an adjustment. So an adjustment, so we're going to have current tax, right, which is actually paid. This is the amount paid. But remember that we said the amount you pay is not the expense. Then the adjustment is called deferred tax. So deferred tax is an adjustment for prepaid tax or accrued tax expense. Then that was what you refer to as deferred tax. And don't worry, it's just an adjustment, an accounting adjustment to current tax. So current tax is what you actually pay according to the rules of SARS, according to the contract. But then you bring that money, that amount, and say, we need to make an accounting adjustment to say, SARS wants us to pay this. The landlord says we must pay this, but those 2 months we didn't pay, it's also an expense for accounting purpose, right? So I hope you have understood why we need to adjust what we pay, right? And that adjustment is done by a process of deferred tax. So we will take you through deferred tax, and we'll show you a very simplified way of making that adjustment, right? You don't have to understand that, but you need to know, right? I will also explain to you how you can do that. Brilliant. So that was the concept of why do we adjust the taxes that are paid. So income tax expense is not what you pay, but is what you pay adjusted for accounting requirements, right? Because what you pay according to the rules, but the rules do not always agree with the accounting standards. So tax laws differ from accounting standards. The landlord says pay 100,000, that's the law. But accounting standards says you recognize the full, whether you paid the portion, whether you paid it or not. Right, and one of the easy marks is for you to be able to know journal entries for tax, for current tax. So you calculate current tax, it's an expense, it's part of the income tax expense. So you can say current tax or income tax, because this is part of that. Right. So if you have paid that, it's going to be bank, going to credit your bank. If you haven't, then it's going to credit your current tax payable. So this is a current liability, right? Your current tax payable is a current liability all the time. Sometimes you can have current tax receivable, and that's a current asset. It's receivable when you, is it receivable? No, because we really don't receive that, but we will have something of an asset when we make a loss, right? But the tax authorities do not really pay us back if we make a loss, because we will make lots of losses, right? And at the end of the day, we will become rich from making losses. So you need to know this journal entry, right? Please know this journal entry. Because those are the things that will give you 1.5 marks. When you are tired of losing marks, then you can get some sucker here. Right? So when we do follow the rules of SARS in adjusting profit before tax so that it becomes taxable income, there are adjustments that we make. One of the adjustments is as a result of SARS not accepting any tax adjustment at all. Right? And this difference between the taxable income and profit before tax is permanent. It's called a permanent difference or an exempt difference. We use the term ED. So remember we said we have sales minus cost of sales plus other income plus other expenses minus finance costs gives us profit before tax. And we said then we catch a taxi and then we go to a SARS office, right? And then we sit with SARS and SARS will be asking us, so how did you determine your sales? We tell them. They will say, tell us to remove this thing and add this thing. So they'll be giving us adjustments. So the reasons why we should make those adjustments, it could be due to two reasons. There could be, SARS could say, this amount thing here you included in your other income should never be included. So according to the rules, there are amounts or there are items that should never be included for tax purposes. It's not like it was, now this is where the point is. It's not like the accounting profit before tax was wrong. It's not wrong, it's correct according to accounting standards, right? But now for tax purposes, SARS will never allow that, right? So SARS will never accept. So they will all the time, they'll say, at all times, whether last year, whether this year, whether the next year, they always say, we don't want that, right? So that is called an exempt difference, like, or a permanent difference. It is a permanent difference between the profit before tax and the taxable income. In other words, it's permanent all the time. SARS will remove that. Will say exclude these things. Right? So whenever you calculate, you know that you will need to exclude that. They're called exempt differences. Then there is also a case where SARS accepts that, but just the SARS may want you to make a tax payment now or later, while accounting requires recognition now or later. So this is an issue of when. But the thing is acceptable. Do you understand that? SARS accepts that. It's just an issue of when should you include it. All right, so that's called a temporary difference. A temporary difference refers to a difference between profit before tax and taxable income as a result of when. Accounting standards say when should you recognize that, then the tax rules say when should it be brought forward for tax purposes. So there's just an issue of somebody says this should be bring it in December, and accounting says no, bring it in your financial statements, bring this thing in February. But SARS says no, bring this in already. We need it for calculating tax. All right, it should be part of what you pay now. And then now the accounting standard says, no, in your financial statements, that same item should be included in the following year. So it's not really that SARS doesn't want it at all. It's just about when. All right. So your temporary differences refers to when does SARS want it and when does accounting standards want it. Whereas we have permanent differences, refers to things that were included in profit before tax, and they should always be removed. They will never be accepted for calculating taxable income, right? So those are the two adjustments we're going to make in in our movement, because remember we are coming from profit before tax, which is the correct amount. Now we are trying to follow the rules of SARS, right? So we normally group into two categories. The first rule is for items that are exempt. Then we follow those items that are just an issue of timing differences. And those two will result in the taxable income. So if you follow here, um, if you follow, uh, so there's a corrected profit before tax. Remember, we would have done the corrections. Then now we are at the office of SARS. Then SARS can say these things that you included. So there is sales minus cost of sales plus other income minus other expenses minus finance costs is equal to profit before tax. Right? So exempt differences or permanent differences refers to things that should not be included in sales, in cost of sales, in other income, in other expenses, in finance costs, should not be included at all. So we will be looking for what was included here. If it is exempt, we take it out. Right? We take out everything that is exempt in cost of sales. If there is anything that is exempt, we take it out. Other income, anything that is exempt, we take it out. Right? Other expenses, anything that is exempt, we take it out. So remember that if we have income is taxable because we pay tax on income. And if we have an expense is deductible because we reduce tax we pay. An expense is deductible. So that's why we say sales minus cost of sales, because we deduct, right? But there are some things that should not be deducted. They are called they are not deductible. Right. In other words, SARS doesn't want you to subtract those expenses because according to SARS, they should not be deducted. So they are non-deductible expenses. So we would have deducted them according to the rules of accounting, normal accounting. We subtract, we add, we subtract. But there are things that are non-taxable. Income that is non-taxable should be excluded. Right. So under exempt differences, we have the exempt differences are made up of non-taxable items. In other words, those things, it's income that is exempt. It's non-taxable item. And expenses that are exempt are referred to as non-deductible. In other words, we should just reverse their effect because SARS will, if we take our profit before tax to SARS will say, no, this thing that you include, this element of income that you included, I don't want you to pay tax on this element of income. So remove this element of income. And then you have to subtract some income because it's non-taxable. SARS says, no, I don't want you to pay tax on this element of income. So take it out. So it's an exempt difference, but it's in the category of non-taxable item income. And then you might have subtracted some expense in your calculation because you're going to tell us the things that you included under cost of sales at the expense. And then SARS will tell you, no, I don't want you to deduct this. So you must add it back. Don't deduct it from profit. So it's called a non-deductible according to the rules of SARS. Non-taxable, non-deductible. Those are the exempt differences. So I say these words non-taxable, non-deductible because those are the words that you will get to see in your examination. SARS, the examiners will not tell you, the examiners will not say this is exempt difference. They will tell you that a portion of that, what was a portion of the income received, is not taxable. Then you remember, oh, I must remove it. It was income. They will tell you this amount is not deductible. Then those are the exempt differences, right? You will understand this over time, right? Because the good thing is that it never changes. It's the same thing over and over. And then so we start with our correct profit, and then we look for those things that are non-deductible expenses, non-taxable income. Then we also adjust for temporary differences where SARS, we have included something in sales, and SARS say, no, you need to include this for next year. Right? So it's a temporary difference. It's not like SARS refuses that at all, altogether rather, but it's just when, an issue of when. So after making those adjustments, we have taxable income. And now remember, we've moved from profit before tax. Now we are at taxable income. These are adjustments for SARS according to the tax authorities. And then we can calculate current tax at 20 or at any tax rate given. It's 27% of this taxable income. Right. Then we get our current tax. And you should know how to do the journal entry for current tax, right? And remember that this current tax is what you actually pay to SARS. Remember. So this is what you actually pay to SARS. And remember, current tax is based not on profit before tax, but on taxable income. After the adjustments are done, then we can apply the percentage to taxable income, not on profit before tax. And remember this, that current tax here is not the income tax expense. This is what we actually pay, and we still have to make adjustments. And those adjustments are referred to as deferred tax. Those adjustments, right? I don't want to talk about recognizing that. So let's talk now about exempt differences, right? So exempt differences, we are talking of income or expenses. Now, these are your standard for your level at that level, right? So we are standing there with our profit before tax, right? The correct profit before tax. And now we need to calculate taxable income. But our the first adjustment is to adjust for exempt differences. So we have to adjust for these exempt differences. So that's why we are here. And so what are those exempt differences we're going to adjust? Remember, we have profit before tax, right? So let me just write that thing down again so that you will always remember sales minus cost of sales plus other income minus other expenses minus finance costs is equal to profit before tax. So we have this amount now. Right? And we read through the information given, and now we've identified the exempt differences. So we look at dividend income. Now, don't worry too much about certain possible differences or certain possible different treatment that can be given to dividend income. Remember that you are only at third level yet, right? So if you might be somebody who is at an level above third level, because this is benchmarked to the University of South Africa students. So you might be somewhere and it's in another institution, and the depth of content is different, right? So we're treating this at third level for the University of South Africa students as a benchmark, right? So if there could be other interpretations that apply to dividend income or anything, we aren't touching on those yet. So Dividend income at our level, at that level, for, right, is going to be part of other income, right? But if you go to SARS will say this dividends income is not subject to income tax. They will tell you that. SARS will tell you that what we're doing here, we want to calculate income tax. So you guys have included dividend income here under other income, but dividend income falls under dividends tax. So SARS will tell you that, not income tax, right? So you guys came here so that we can calculate income tax, but you are putting in an amount for dividend income. So it's not taxable. So please take it out. So it has to be removed from profit before tax, because other income increases profit. It's a plus. We have sales with plus other income. Cost of sales reduces profit before tax. Other expenses reduce profit before tax. Finance costs reduce profit before tax. So it's only sales and other income that increase profit before tax. Now, SARS at the office says, we want you to remove this income, right? So the effect on the effect of that adjustment on profit before tax is to reduce profit before tax. And if something reduces profit before tax, then it's also reducing how much tax you eventually pay, because your taxable income will be smaller because we keep reducing amount. If you keep reducing this amount, subtract this amount, remove this amount, this income, then it keeps on reducing your profit before tax. Eventually, the final amount is your taxable income is very small. So the effect of dividend income, which is not taxable, is to reduce this. This is important when you are doing the reconciliation, right? Another rule, and I want you to know this as a rule, is that there is what you refer to as capital profits. We will demonstrate to you with an example now. So I have an example that we're going to cover, but we will demonstrate that. So there is capital profits, right? 20% of that is not taxable. So we have to subtract that under other income. And so the effect is to reduce profit before tax. And then there are fines or interest and penalties for non-compliance. These are not deductible. Remember, these are expenses. We paid a fine to the environmental authorities for breaking the law, right? SARS will say, no, but you can't, because this is not incurred in the production of income, right? And because it's not in the production of income, we can't allow you to subtract it so that you might disobey the government and pay a huge fine and then end up paying small tax. But your fine, your interest and everything is not in the production of income. It's not deductible. So you need to add it back. So you add back the fines and donations, because you can end up donating everything you have, right? So generally your donations are not tax deductible. So you add them back if there's any donation. Now, remember, these are generalizations, right? Then gross foreign income, you get income from another country, but that country would have tax due. So you come out that income comes to South Africa, and then you pay tax again. So to save you from double tax, there are agreements called double tax agreements. So if you tell the people that, guys, I received this money from this country, I paid tax, then they will say, okay, we're not going to tax you again, right? And so you need to remove that amount so that the amount we are left with is the amounts on which tax will be paid. Since this foreign income will not be taxed, please remove it from your other income. So the effect of removing that from other income is to reduce profit before tax, right? Why did I say increase here? Because it's actually reduce. I wonder if I didn't make. Right, so it's actually reduced there, it doesn't increase. Then what we're saying is that no, not capital. I didn't want to say capital. I wanted to say add back or non-deductible expenses. Sometimes some of these expenses are not um, standard, right? They will have to tell you that they received an insurance or there's an expense, this happened this way and that way. This is not deductible. Then you know that, okay, I must add it back because it's not, I'm not supposed to subtract it. It will increase. Then it will increase your profit before tax. Then there is also all non-taxable incomes. Here we have identified for you dividend income, 20% of capital profits, and foreign income. Right. But you need to know that any other income which is labeled as non-taxable, you need to remove it because we want to be left with an amount on which tax is going to be paid. Right. And there's sometimes there's research costs where if you have a research cost of 2,000, but then you deduct 2,000 and you also deduct 50% of that 2,000. Right. Remember the actual expense is 2,000, but the deduction is 150%. So there's an extra 50% which can be deducted further. So we must deduct that. So it will reduce what we pay. And then there's also depreciation on assets which are tax exempt. Like, so if you see depreciation on office buildings, administration buildings, the default, before we have any for further information, the default is that their depreciation is not deductible. So we have to add back that depreciation. Right. So everything that I gave you here, dividend income, fines, donations, foreign income, depreciation on office or admin buildings, even if the examiners don't mention to you that this is non-deductible, this is non-taxable, even if the examiner doesn't mention, those are default. All right. And remember I said this is being benchmarked to University of South Africa students at third level. So if you could be doing this as a general student, it should work to a large extent, but there might be minor differences because universities will define the way they present their stuff, right? And here I said gross, well, sometimes the examiners will tell you that they paid 25,000, their company paid 25,000 foreign taxes, and then they received 75,000 after paying tax. So the amount that will be included in profit before tax is the full amount of 100,000. Remember that the amounts that are included in under income and expenses are the full amounts, right, before deducting any tax. Then, so if they tell you that they paid tax of 25,000, and then the income that was actually received net of tax is 75, you need to remember that it's the 100,000 that we are dealing with. When we say deduct foreign income, you don't deduct the 75, you deduct the full 100. Right. Brilliant. And now this takes us to an example. Now this example is going to help us. It's going to help us appreciate what we've been talking about. So we have Duck Swiss Limited. So it has a profit before tax of 800,000 as calculated by the accountant. The following information is applicable. Right. So the required, I prepared this and we all know what the required is, right? So the required is to, okay, I say here, they disclose the income tax expense note as required by IAS12, right? So that might seem for you to be a jump, but what I could have broken this into, normally what the examiners do is they break it down for you. They start by saying, calculate the correct profit before tax, right? And they say, calculate the current tax to be paid, current tax, right? and then they will say, disclose the income tax expense note. So the income tax expense note will obviously require you to do all these steps: correct profit before tax, current tax calculation, and the disclosure. So when I say disclose here, it's because I'm taking you through everything. So I didn't want to just say do this, because I'm going to do that with you. So our starting point is to correct the profit before tax for any mistakes, errors, or anything that is wrong. Right. Right. So the profit is 800,000, profit before tax. So let's look for the mistakes first. Um, the amount above includes dividends of 10,000 which are not taxable. Now, the fact that they are not taxable doesn't mean that they are a mistake. Right? We will adjust that when we go to the office. We don't start by going to the office of SARS. Remember, we start by fixing our financial statements, our income statement. Then when it is clean, it is neat, it is well done, then we take a taxi and go to the taxman. And then there we are going to apply the rules of whether it's taxable or not. But we are still in the house. We want to make sure that the amounts we bring to SARS are going to be correct. And then we can discuss with SARS as to how much should the adjustments be. Right, so this is it's not taxable, so it's an exempt difference. And then the amount above excludes, we are told, fines and penalties from SARS charged for non-compliance, 15,000. So I know this 15,000 is, we are told it's excluded. But if you pay a fine, that's an expense. So we have to subtract the 15,000 because it is an expense. Remember, our starting point is to calculate the correct profit. So if there are some expenses which are not recorded, they have to be recorded. Remember, we are not yet at SARS. We are still in the office, right, sitting and doing the calculations. And we say, all right, we forgot to record this expense, and we need to subtract that. So included in the above amount is depreciation of office buildings. So this is already included. Right? So we are told it is not tax deductible. So it's going to be an exempt. And we also know that fines, when we eventually get to SARS, they are also exempt because they are not tax deductible. So nobody is going to tell you that a fine is not tax deductible, because that's way too obvious to be told. Right? So the reason why we are subtracting it here is because, firstly, on our side, our profit before tax for accounting purposes has to be accurate. Then after that, we will take that correct profit before tax. We take a taxi and get to SARS. And when we get to SARS, we begin a different period of different session of adjustments. So during the year, DAC Swiss received 40,000 from Namibia. They paid 75 taxes on this amount to Namibian authorities. This income from Namibia is not taxable due to double tax agreements. And you know, this is non-taxable item. This is exempt. So DAC Swiss made donation of 25,000 during the year. These donations are not tax deductible, right? So this is a non-deductible expense. This, we are not told that this was not recorded, right? So we understand that it will be part of the expenses already deducted from there. Then the profit before tax above excludes profit. It excludes profit made from the sale of equipment. Equipment with a carrying amount of 30,000 was sold for, my apologies, they were sold for 100,000. The equipment was originally bought for 90,000. Now, for accounting purposes, we need to determine the profit made because we need to include the profit under other income. Or if it is a loss, then we're going to include it under other expenses. So it was sold for. Selling price is 100,000. And you subtract the carrying amount on the date of sale, right? Not on any other date. So it's 30,000, right? And then we have 70,000 profit, right? So that's the adjustment too, because we're told this excludes, so it's not recorded. And so our profit will be wrong if we forget to include this 70,000, right? Then sales made on the last day of the year amounting to 45,000 are still to be recorded in the accounting records. So this 45,000 should be included. All right. So we start now and say our profit before tax, which is given, was 800. Then we add sales that were omitted. We are still in the office with the clerk and the accountant and the finance manager. We are correcting our financial statements. So we add 45,000. Don't worry about cost of sales or anything. I'm just demonstrating to you how I'm just demonstrating to you the steps. Then the profit on the sale of equipment, selling price minus carrying amount, 70,000. Then there's those fines and penalties which are supposed to be deducted, 15,000. So the corrected profit before tax is 900,000. This is corrected in the office, right? Before we take a taxi, before we take an Uber to SARS, we need to have a correct profit before tax. Now, using this 900,000, we take a taxi, an Uber, we get into Taxify, into Bolt, then we bolt towards the SARS. When we reach to SARS, now with a correct amount, SARS is going to look at that and say, fine, thank you very much. This is what we're going to do. And SARS will say, take this out, do this, do that. So what SARS is going to do, now we're looking for exempt differences as our starting point. Right? Remember, we have exempt differences and temporary differences. So we start with the exempt differences, which are permanent differences. Right? Well, it's not a rule that you have to start with the permanent differences, but that's what we do. So this 10,000 is not taxable. So it's dividends, not taxable. So they were included in, now we are at SARS, we are telling SARS, so we are looking at our sales minus cost of sales, minus plus other income, minus other expenses, minus finance costs is equal to profit before tax. So we have corrected everything. Everything is correct now, right? So everything is correct, it's perfect. So we sit there, we take our Taxify, we have arrived at the office. Now, SARS is going to ask us, what is your other income made up of? Then we divulge to SARS and say, no, it includes dividends of 10,000. But SARS says, no, I don't want that amount. For the purpose of calculating tax, I'm not going to calculate current tax on dividends because dividends have dividends tax. Here I want income tax. So remove the dividends. So I'm going to say the profit that we have, we're going to look at it. It's 900,000 and we remove the dividends. What are we doing now? We are looking for the taxable income against which we can say the tax rate 27% times the taxable income. And for us to get that taxable income, we begin a process of adjusting the profit before tax, the correct amount here. We adjust that. As we sit with the SARS officer, we tell them our sales is made up of this, our cost of sales is made up of this. They'll say, no, remove this, add this back, do this. So we're following those rules. So the first thing is we tell the SARS officer, our other income includes dividends. And this officer says, no, but dividends are not taxable according to income tax. They are taxable according to dividends tax. So remove them. Because what we're doing here today, we want to determine income tax. So they are not subject to income tax. So remove them. And then we remove them. And Then they say, so what are your other expenses made up of? And we say there is fines and penalties, and say, no, that's not in the production of income. You subtracted it. I want you to add it back. And then we add it back because this one was not taxable. This one is non-deductible. So add it back. Then then they say, what is your other expenses made up of again? And we say depreciation of office buildings. And they say, no, you can't deduct that because it's already deducted under other expenses, right? It has affected profit before tax. And then NISA says, no. We don't allow that deduction. For tax purposes, it's not tax deductible. It's accounting deductible, right? But for tax purposes, add it back. So we add back 10,000, we comply. We are there in the office now. And they ask what else? And we tell them that in our other income, there is income from Namibia, 40,000 rand. And SARS will say, no, I don't want you to pay tax, income tax on that because we have a double tax agreement with Namibia. So I want you to remove the 40,000. So we subtract 40,000 because it's non-taxable. It's not taxable. Then we ask, the SARS guys ask, what else is there in your other expenses? We'll break down the expenses and we'll say, no, we made a donation of 25,000. It is an expense. And SARS says, yeah, but for accounting purposes, you cannot deduct that as an expense. So please add that back. So we come and add that back as 25,000. Not because it was wrong for accounting purposes, but now what we're doing is not accounting. We want to pay tax. We are at the office and we are shaking there in front of SARS, right? And then SARS also asks us and says, so what is your other income made up of? We tell them what we sold the equipment. How much did you sell that for? We tell SARS we sold it for 100,000. SARS will not ask what was its carrying amount. It will not ask. SARS will ask what was its original cost. That is what SARS is going to do, right? And we tell them it was 90,000, right? So, and SARS will say, okay, so above the 90,000 original price, right? You guys got 10,000 capital gains, capital profit. So the capital profit is the profit made above the original price. Now, for FAC third level purposes, the cost is always equal to the base cost. The cost of an asset is always equal. And I say this is for we benchmarking everything to UNISA third level, FAC module. If you go to taxation module for UNISA as well, then it could differ because there's a lot of adjustments. But for FAC purposes, we don't want that headache. So we just say the cost that you are given is the base cost. So the 90,000 rand, the selling price above base cost, and the original cost is the base cost because we don't want things that are difficult. So we made 10,000 capital profit, and SARS will say, right, on that capital profit, it's capital gains. Capital gains is income tax. So we want that 10,000, but not all of it. You should include only 80% of that. So if you see this instruction says the capital gains inclusion rate is 80%. So we don't include the entire 100% profit. So just 80% should be included. So if we're going to include 80%, then it means that 20% is excluded in the calculation of income tax. So we come here in the office, and SARS says no. So the 20% of that 10,000, which is the capital profit, should be excluded. And then we say, all right, thank you, sir. And we say, we must subtract 20% of that capital gain, which is 10,000. Remember, the capital gain is the selling price minus the base cost, right? So we are done. So now we start the process of calculation to say the correct profit before tax is 900,000. Then we had dividends. SARS says we must subtract them. We subtract because they are not taxable. Then there are fines and penalties. SARS says add back the fines. So this is the calculation. We are in the SARS office now. We are at SARS LBA, and it's looking very scary, right? Because previously here we were in the office and we were doing our own calculations. Now we took an Uber, we went to the SARS office, and things are not looking very good because we are shaking there, right? Then we had depreciation. SARS says, you guys subtract depreciation for accounting purposes, it's fine. But now we're not doing accounting. We just want to determine how much. So we are trying to calculate current tax or taxable income by adjusting the corrected profit before tax according to the tax rules. So we're following the rulers. They say add back your depreciation, then we add it back. And we tell them about the foreign tax and say the foreign income. Say, no, take that amount, the whole amount out because I don't want it. Then we told them we made donations. They said, no, you can't deduct that, add it back. Then we told them we sold something and we made a capital profit. Then they said, no. Only 80% we want. The 20%, remove it. So after all these adjustments, the net effect of all these adjustments is that our corrected profit before tax will be reduced by 2,000. Please don't ask me because sometimes students do a calculation and maybe I made an error in punching my figures for the calculator, then it's not really 2,000. That's not the point. Please, let's focus on the principle, right? And not on the 10 plus 5 and you get a different figure and you want to email the tutors to say, hey, I added up 4 and 5, I didn't get 8, I get 9 here, All right. So our 900,000 is going to be adjusted minus 2,000. The taxable income before temporary differences is 898. Then the temporary differences is the temporary differences is our deferred tax, guys. But we haven't covered that. So for now, there's nothing. But we will do that. But for now, we haven't. So the taxable income is going to be 898. Now, on this taxable income, you're going to apply the tax rate. We are told the applicable tax rate is 27%, right? So we're going to say 27%, not of the profit before tax, but 27% of the taxable income. So when you do this calculation, your lecturers want you to show this tax rate and the taxable income coming from here, right? And that is what you're going to pay to SARS, right? So that is what you're going to pay to SARS. So you're going to debit. If you pay that, you're going to debit current tax with 242. You're going to credit bank with 242. If you don't pay, you're going to credit current tax payable SARS with this amount. And remember that will be a current liability. But sometimes the examiners say disclose the statement of financial position. And remember that you need to remember that your current tax is part of the current liabilities. Right? Now, so what is going to happen now when you prepare your financial statement? When you prepare your financial statement, so what's going to happen is right. So this is what is going to happen when you prepare your financial statements. You have right. For now, we haven't done any adjustments. So our current tax is 242. Right. So it's 242. Right. All right. 460. I remember that we paid Remember that we paid how much? Foreign taxes. We paid 7540, right? So we paid, I want to add that, so I'm taking 7540 plus. So this is what I paid to Namibia. It's a foreign tax. And then in South Africa, I paid 242, 242,460. This is what I paid. So in total, I paid 250,000. You agree? But I don't have any adjustments because this is what was actually paid. Remember, the income tax expense is what was actually paid. All right. But an expense is not the amount paid, it's the amount incurred. So what was paid has to be adjusted for accrued or prepaid. But in this case, we don't have any accrued or prepaid. So your temporary differences will give you the prepaid or the accrued, and we haven't covered that yet. So there's no adjustment yet. So we paid 250,000 plus no adjustment. So it's still 250,000. That's the expense. But if you look at 250,000, so in your financial statements will look something like this, right? We will say profit before tax. The correct amount that we worked out in the office, the corrected amount is 900, right? 900,000. And then the income tax expense, which is your current tax plus your foreign tax plus adjustments. And here we don't have adjustments, so that's 250,000. Do you see here now at that level, we have to calculate that income tax expense. It's not going to be given to us. So our profit for the year, right, will be whatever it is. But do you understand here that the income tax rate is 27%? Do you understand that? Do you understand that? So your users of financial statements will say profit before tax 900, right? Then income tax expense, they will say, the users of financial statements will say 27% of 900,000. And they get 243,000. But that's what they, all right, that's what they expect. Then they actually get surprised that you guys paid 250. Why? Instead of 243. So you have to explain to them how, when you took a taxi and you went to SARS, how all these things here, SARS, which was telling you, led you to eventually paying 250. What happened? So you have to explain in a note called a tax rate reconciliation. Because the user of financial statements will look and say, but shouldn't it be just 27% of this? Why did you say 250 instead of 243? Then you have to explain to them to say, no, this 900,000, you see it there. We went to SARS. SARS says, take this out, remove this out. That's why we ended up paying this. It's called a tax rate reconciliation. So I'm going to show you how to do that. A tax rate reconciliation. So it's a story that you're telling the users of financial statements to say, what happened? Because the users of financial statements, you gave them the accounting profit or profit before tax of 900. And then they expect the standard tax should be. So that is their expectation, 27% of this. Because this is your profit before tax, 900,000. Then your income tax expense, 250. But they expect that to be 243. And then you are telling them, no, the reason why it's not 243 as you would expect is because the amounts were adjusted for tax effects of exempt items. We went to SARS. So the taxable income was reduced by 10,000. And because the taxable income was reduced by 10,000, 27% of that 10,000 was obviously removed as well. because dividends were 10,000 and we were told to remove the dividends. So that means that there is a 10,000 in the year, right? On which tax was not paid. There's a 10,000 included in the 900, but on that 10,000, tax was not paid. So that reduced our tax by 2,700. Then there were fines and penalties. We went to SARS. SARS said, no, add this back. So that increased how much tax we paid, right? So this increased. So the tax that we paid was increased by 27% of the amount added back. So we ended up paying more on this amount. Then SARS says we must subtract 2,000 capital profits. And because we reduced the amount, the tax paid was also reduced by 27% of the amount reduced. So we ended up paying less by 540. Then we had donations. Then it was 25,000. And SARS says we must add back to the 900. So that adding back increased the tax we paid by 27% of the amount we added back. So we ended up paying 6,750. Then there's a depreciation of office buildings, 10,000. SARS said we must add it back. And because we added that amount back to taxable income, that increased our profit. The tax we paid also increased by 27% of that amount. And then there was an issue with some money from, what is that thing called? Namibia. Namibia asked us to pay 7,540. So instead, we didn't pay the difference. If it was in South Africa, we would have paid 27% of 40,000, right? So we would have paid 10,800. But we only paid 7,540 because this tax was paid in Namibia, and in South Africa, they didn't charge us at all. So in South Africa, we would have paid 10,800. But then we only paid 7,540. So because we paid less than what you guys would expect, that what the standard would have been at 27%, we got a benefit of 3,260, which reduced our tax burden. So eventually, the net effect of all these adjustments was an increase of 7,000 as a result of the exempt item. So instead of paying just 243, these adjustments, the exempt items, the adjustments added another 7,000 to the tax. That's why we ended up paying 250,000. So the 250,000 is the effective tax. This is the income tax expense. So the effective tax is the income tax expense that you include below profit before tax, right? Then profit before tax, then income tax expense. That's the effective tax of 250. Right. So with practice, you will understand these things. We're just explaining to the user who would expect us to have paid 27% of 900. So no, that figure, when we went to SARS changed that amount by 10,000. So the effect of the change is also 27% of the 10,000. Then they changed again another 50. And the effect on tax is 27% of that. So that is what happened. Or what you can do if you want to be a crook, like I would say you should be, right. So in your calculation here, right, you can just take this from there. You see, where did I say this? Did I say that? Where did I say it? Where did I say it? I should have said it. Right, now I remember that. It's here where I said the exempt differences are reconciling items. So from your exempt differences here, you must have known that all these adjustments on your exempt differences were affecting tax. Right? The final effect on tax is 27% of that amount. So when you do your tax rate reconciliation, you can always come here. And right. I don't want to give you a trick that I was going to give you a trick now, but I don't want to give you a trick that I'm not going to sustain if you're not going to be in our class. Because if you're in my class, then I'll give you a trick, that a shortcut, but I will also help you apply and sustain that. So basically, this is the story. Now, this is the disclosure. How do you disclose it? Right. Yeah, you start, as you know, by the name of the entity, the notes for the year, what? Then this is the income tax expense. Then you have to show that you are now going to disclose the major components of the income tax. Remember, income tax is made up of the current tax, which is what you paid to SARS, plus the foreign taxes, which is what you paid. Don't worry too much. And then the adjustments to what you actually paid. Right. And you know the rules. So current tax, the current tax you paid, the current tax applicable for the current year, right? And maybe, because remember we are estimating, so maybe last year our estimate, there was an underestimate, it's an under or over provision. So we make adjustments now. Because we estimate first before going to SARS, then we eventually go there, and then we argue, and then we see that we need to adjust the estimate from previous years will be included in the current year. Then don't worry about this. That is deferred tax. It's very simple. We will show you a very simple and soft way of doing it. Then foreign taxes. So this deferred tax now is an adjustment to this figure to say this is what was actually paid, but this is the adjustments to that. This is what was then the income tax expense. Right, brilliant. So I hope you guys have enjoyed it. It's almost 2 hours, but I hope that it is very enriching, because that's what I want to happen. I want you to be enriched, and I don't want you. Right. Let me repeat that. I spoke about a certain demon that enters into students when when the lecturer says calculate the correct profit, then students say, do you see here the correct profit? There are errors, right? But the lecturers are going to say calculate the correct profit. Then students start with the profit before tax, which is given as 800,000, and then they come and subtract dividends. That's how they do. Then they subtract add back penalties, and then they get the correct profit. And I don't know if I have explained that enough, but can you see the difference between a correct profit? Correct profit, we are still in the office, not even talking about SARS. Then we take a taxi. Now we go to SARS. When we arrive, we are in the SARS building. Now we can talk about what is SARS, what are the rules of tax saying. So please, the examiners, when they say calculate the correct profit before tax, don't come and start talking about not deductible or deductible. We are still in the office, in our own premises. From there, we're going to take a taxi. We go to SARS. Then SARS will give us their rules based on our correct amount. We cannot go to calculate to the SARS offices with the wrong amounts, from our office. So first thing, our own financial statements have to be correct. Then we can take a board towards SARS. We sit down, we start adjusting the corrected profit before tax according to the rules of SARS. Then, right, then we are happy. So I want you to practice this little example here. This little example here is as everything given to you. So I want you to practice this, right? So if you are watching on a recording, I want you to stop this here. So I don't want you to scroll back to a cleaner picture. So I want you to take a screenshot, or I don't know if you can take a screenshot, or just stop it here and start calculating, start with the calculations for, start see if you can reproduce the thing. It's very straightforward. It doesn't have a lot of calculations, right? Then after that, you can compare your answer with this and see where did you go wrong. So I want you to keep on practicing this little thing here until you get it right. So this little thing here has has three things that we must actually four. So I want you to practice calculating. So your first required here, I'm giving you a required, is to calculate. Let me put the required here. So the first required is to calculate profit before tax, corrected. Then second one is to calculate current tax, right? Your third one is to do um, income tax expense note. Yeah, right. Then the fourth one is to prepare a tax rate reconciliation. Now, a tax rate reconciliation is part of the income tax expense note. But sometimes they just say, they will tell you to exclude the tax rate reconciliation or include. Although it's a part of the same thing, but the examiners have a habit of actually telling you to, or rather highlighting that this is required to be included. So I'd like you to practice this, right? And you have seen the explanations, right? So can you try? I'm going to remove the marks so that you can, when you review your own answer, you don't have to scroll back. You can just work on this. I think that's clean enough, right? So can you just check with yourself, can you do this? If you are not sure you understood properly, you may start again, right? And if you have a problem, um, you can contact us and we can try to help you, right? All right. So thank you very much, and we wish you very good studies. So remember to exhaust all our recordings because this is just the introduction. We're gonna do another one for temporary differences, deferred tax. Then we're gonna do for advanced material like your assessed losses, changes in tax rate enactments, and so forth. Then we will also give you exercises, exercise one, previous exercises, previous assignments that will give you a lot of practice. So remember to like and subscribe to our um, to our YouTube channel, right? All right, and we wish you the very best in your hard work.